Let's get right to it. Today, we're exposing the 5 riskiest FTSE 100 shares, according to Yahoo Finance. The FTSE 100 is the UK's stock market elite, but big names don't always mean safe bets. Some of these giants are balancing on a financial knife edge, and if you're not careful, your money could be at risk. We'll break down why these 5 companies are flagged as high risk, looking at their debt, market position, and the pressures they face. My goal isn't to tell you what to buy or sell, but to give you the tools to analyze risk for yourself, because ultimately, you're the best manager of your own money. Let's dive in. First up is Ocado Group. Yes, the online grocery delivery company, but their real play is tech. Ocado sells its robot-powered warehouse systems to supermarkets worldwide, pitching itself as the future of grocery logistics. The dream? Every major supermarket pays Ocado for automation. The reality? It's been a bumpy ride. Ocado has struggled to turn a profit for over 2 decades, burning cash on R&D and expansion. Their business is fueled by investor confidence. If that dries up, so does their runway. The share price is a roller coaster, swinging wildly on news and rumours. Buying Ocado isn't buying a stable grocer. It's a high-risk bet on their tech becoming the global standard. The competition is fierce. Amazon and others are racing to automate too. Even existing partnerships, like with Marks & Spencer, have faced challenges. In a high-interest rate world, investors want profits now, not promises. Ocado's chart is all peaks and troughs, exciting for traders, nerve-wracking for long-term investors. You're betting on a promise that's taking a long time to deliver. High risk, high reward. But the path to profitability is still unclear. The company's fate hinges on executing a global strategy in a crowded field. If they win, the upside is huge. If not, losses could be just as dramatic. Ocado is the definition of a speculative tech play. Know what you're betting on before you jump in. Let's move to the next risk. Number 2 is Rolls-Royce Holdings, not the car maker, but the aerospace giant powering Airbus and Boeing jets. Their power-by-the-hour model made them cash-rich until the pandemic grounded planes and their income vanished. To survive, Rolls-Royce took on billions in debt, sold assets, and raised cash from investors. Now, a huge chunk of earnings goes to servicing that debt, not growth or dividends. High debt makes them vulnerable. Another downturn or rate spike could spell trouble. The aerospace industry is cyclical. When travel drops, so do their profits. Developing new engines is a massive, risky investment with no guarantees. The company is restructuring, cutting costs, and trying to pay down debt. The share price has rebounded, but the risks remain. Their future depends on strong travel demand, successful new products, and careful debt management. Any global crisis could set them back again. Investing in Rolls-Royce is betting on a recovery story, one that's still heavily leveraged. The turnaround is promising, but far from complete. You're not just buying engineering excellence, you're buying into a high-stakes comeback. The risks are real, and the debt is a heavy anchor. If you invest, know you're riding the ups and downs of a volatile industry. Let's see who's next on the risk list. Next up, the airline industry itself. Stay tuned. Third is International Consolidated Airlines Group, parent of British Airways, Iberia, and more. The pandemic nearly wiped out their revenue, but costs kept piling up, forcing them into heavy debt. That debt still weighs on them, making IAG vulnerable to shocks. Airlines face brutal competition, high fixed costs, and razor-thin margins. Fuel prices, staff strikes, and economic downturns can all devastate profits. Low-cost carriers undercut them on price, while premium airlines outshine them on service. Demand for travel is fickle. When the economy wobbles, so does IAG's revenue. Regulations and the push for net zero add more costs and complexity. The bounce back in travel has helped, but the industry's fundamental risks remain. IAG's profitability can be derailed by oil prices, strikes, or even a volcanic ash cloud. Investing here is a bet on travel's continued strength and IAG's ability to manage debt and competition. It's a tough, volatile business. The risks are baked into the share price for a reason. If you want stability, airlines are rarely the answer. Let's move from the skies to the high street. Next, banking. Fourth is Barclays, one of the UK's banking giants, but not without risk. Banks profit by lending, but when the economy sours, defaults rise and profits fall. Barclays' big investment banking arm makes it even more exposed to global market swings. Regulatory fines and scandals have hurt its reputation and bottom line. Post-2008, strict regulations mean more capital reserves, limiting growth and profitability. The investment banking division is a double-edged sword. Big profits in good years, big losses in bad. Competition from fintechs and challenger banks is heating up, forcing Barclays to spend heavily on tech. Interest rates are a wild card. Rising rates help, but too high can trigger defaults. The market values Barclays below its book value, reflecting skepticism about its future. It's a leveraged bet on the UK and global economies, with plenty of volatility. Not a risk-free investment by any stretch. If you invest, understand the cycles and the competition. The potential for things to go wrong is significant. Let's wrap up with a look at the housing market. Last up, Persimmon. Finally, Persimmon, the house builder riding the waves of the UK property market. For years, low rates and housing shortages fueled a boom, but that's changing fast. Persimmon's fate is tied entirely to the health of the UK housing market. Rising interest rates make mortgages expensive, slashing demand and threatening prices. If house prices fall, profits can vanish or turn to losses. Costs are rising too. Materials, labour, and planning delays all squeeze margins. Reputation issues and government policy changes add more uncertainty. The end of schemes like Help to Buy removes a key support. The planning system is slow and unpredictable, making future growth lumpy. Investing in Persimmon is a concentrated bet on UK housing staying strong. That's a lot of risk factors outside the company's control. The property market is cyclical and can turn quickly. Know the risks before you build your position. Let's bring it all together. There you have it, the 5 riskiest FTSE 100 companies, each with their own pitfalls. The lesson? Do your own research. This is a guide, not advice. Dig into the numbers, understand the business, and weigh the risks for yourself. Never invest in what you don't understand. It's your money. Take control and make informed decisions. Which FTSE 100 share do you think is riskiest? Let me know in the comments. Thanks for watching. Don't forget to like and subscribe for more insights.